In the summer of 1999, as Y2K fears gripped the nation and dot-com valuations soared to astronomical heights, a grocery delivery startup called WebVan went public with perhaps the most audacious business plan Silicon Valley had ever seen. The company raised $375 million in its IPO, giving it a market capitalization of $4.8 billion on its first day of trading. To put that in perspective, WebVan was worth more than established grocery chains like Whole Foods, despite having never turned a profit and operating in just a handful of cities. The company's founder, Louis Borders, co-founder of the Borders bookstore chain, promised investors that WebVan would completely revolutionize how Americans bought groceries. Customers would simply log on to WebVan's website, select from 50,000 different products, and have their groceries delivered to their doorstep within a 30-minute window of their choosing. It was Amazon for groceries, Uber Eats for everything, and Netflix's convenience model all rolled into one, except it launched in 1999 when most Americans were still using dial-up internet and had never heard of online shopping beyond buying books or airline tickets. The vision was intoxicating to investors drunk on dot-com dreams, but the execution would prove to be one of the most spectacular business disasters in corporate history. Louis Borders was not your typical Silicon Valley entrepreneur. Having co-founded the Borders bookstore chain with his brother Tom in 1971, he understood retail, inventory management, and consumer behavior. After selling Borders to Kmart for $125 million in 1992, Louis had both the credibility and capital to pursue his next venture. His experience watching customers browse bookstores had given him insights into shopping behavior that he believed could be revolutionized through technology and logistics. In 1996, he began developing the concept for WebVan with a team that included former Borders executives and grocery industry veterans. The core insight was simple but profound. Grocery shopping was a chore that people would gladly outsource if the service was convenient, reliable, and competitively priced. Borders calculated that the average American spent 2.5 hours per week grocery shopping, including travel time, and was willing to pay a premium to get those hours back. Market research suggested that busy professionals, working mothers, and elderly customers would embrace grocery delivery if it worked seamlessly. The plan called for WebVan to build massive automated distribution centers that could process orders with military precision, dispatch delivery trucks that could reach customers within 30-minute windows, and do it all while maintaining the freshness and quality that grocery shopping demanded. The business model that emerged from Borders' vision was breathtakingly ambitious in scope and complexity. WebVan would build fully automated distribution facilities that resembled something between an Amazon warehouse and a NASA mission control center. These facilities, which the company called customer fulfillment centers, would span 330,000 square feet and feature robotic carousel systems that could pick and pack groceries at superhuman speed. The company partnered with Bechtel, the engineering giant behind the Hoover Dam and the Big Dig, to design and construct these technological marvels at a cost of $35 million each. Inside these facilities, 4.5 miles of conveyor belts would transport products while computer systems tracked every item through radio frequency identification technology that was cutting edge for the era. The plan called for each facility to handle up to 8,000 orders per day while maintaining strict temperature controls for frozen foods, fresh produce, and dairy products. WebVan's delivery fleet would consist of custom-designed trucks equipped with GPS tracking, mobile computers, and separate compartments for different temperature zones. Drivers would follow optimized routes calculated by proprietary algorithms, making deliveries within precise 30-minute windows that customers could select online. The company promised to offer 50,000 different products, from fresh salmon and organic vegetables to household cleaners and baby food, all at prices competitive with traditional supermarkets. What made WebVan's business model so seductive to investors was the promise of incredible unit economics once the company reached scale. The pitch deck that circulated through Sand Hill Road venture capital firms painted a picture of a business that would become extraordinarily profitable by eliminating the costs associated with traditional retail. WebVan would not need expensive storefronts in prime locations, massive parking lots, or armies of cashiers and shelf stockers. Instead, the company would operate from industrial areas where real estate was cheap, using automation and technology to drive down labor costs. The financial projections showed that once a distribution center was processing 2,000 orders per day, the unit economics would become positive, and profits would scale dramatically as volume increased. At full capacity, handling 8,000 orders daily, each facility would generate gross margins of 25% while serving a customer base of 50,000 households. The company's financial models suggested that customer acquisition costs would be manageable because satisfied customers would become repeat buyers, ordering groceries multiple times per month. WebVan projected that the average customer would place orders worth $75 every 2 weeks, generating annual revenue of nearly $2,000 per household. With minimal customer acquisition costs after the initial marketing blitz and high customer lifetime values, the business appeared to have the potential for enormous profitability. The reality of executing this vision proved far more challenging than anyone at WebVan had anticipated. The company's first distribution center opened in the San Francisco Bay Area in June 1999, and problems emerged immediately. The sophisticated robotic systems that were supposed to revolutionize order fulfillment broke down constantly, forcing workers to pick orders manually at a fraction of the intended speed. The computer systems that managed inventory struggled to track the freshness dates of perishable products, leading to situations where customers received spoiled produce or expired dairy products. The custom-designed delivery trucks, which had cost $85,000 each, experienced mechanical problems and proved difficult to repair because of their specialized components. Most critically, customer demand was far lower than projected, making it impossible to achieve the order volumes necessary for profitability. During its first months of operation, the San Francisco facility was processing fewer than 500 orders per day, far below the 2,000 orders needed to break even. The 30-minute delivery windows that WebVan had promised proved extremely difficult to maintain because of traffic congestion, order processing delays, and the simple logistics of navigating delivery trucks through residential neighborhoods. Customer complaints poured in about missed delivery windows, poor product quality, and website crashes during peak ordering times. Despite these operational challenges, WebVan's leadership remained convinced that the problems were temporary growing pains that would be resolved through better execution and increased scale. The company decided to accelerate its expansion plans, believing that rapid growth would allow it to achieve profitability faster and establish dominant market positions before competitors could respond. In late 1999 and early 2000, WebVan opened new facilities in Atlanta, Chicago, Los Angeles, Orange County, Portland, Sacramento, San Diego, and Seattle. Each new market required the same massive upfront investment in distribution centers, delivery trucks, local hiring, and marketing campaigns to attract customers. The company was spending approximately $50 million to enter each new market, money that would not be recouped unless the facilities achieved profitability within 18 months. WebVan's burn rate accelerated to staggering levels, with the company spending more than $100 million per quarter by mid-2000. The expansion strategy was based on the assumption that early entry into major metropolitan markets would create insurmountable competitive advantages, but it also meant that WebVan was multiplying its operational challenges across multiple cities simultaneously. The dot-com crash that began in March 2000 created an existential crisis for WebVan that exposed the fundamental flaws in its business model. As technology stocks plummeted and investors became skeptical of unprofitable internet companies, WebVan's market capitalization fell from its peak of nearly $8 billion to less than $1 billion by the end of 2000. The company found itself burning through cash at an unsustainable rate while facing increasingly difficult conditions for raising additional capital. None of WebVan's markets were approaching profitability, and the unit economics remained stubbornly negative despite 18 months of operations. The average order size was just $81, significantly below the $103 that the company needed to break even on deliveries. Customer acquisition costs were running at $82 per household, but many customers were placing only 1 or 2 orders before abandoning the service. The gross margins on delivered groceries were just 4.8%, far below the 15 to 20% margins that traditional supermarkets achieved. WebVan's management realized that the company would need to raise hundreds of millions of additional dollars to reach profitability, but investors were no longer willing to fund businesses with unproven economics and distant profitability timelines. In a desperate attempt to achieve profitability and satisfy investors, WebVan made increasingly aggressive cost-cutting measures throughout 2000 and early 2001. The company laid off more than 2,000 employees, representing nearly half of its workforce, and closed operations in several markets including Atlanta, Sacramento, and Orange County. WebVan also attempted to boost revenues by expanding beyond groceries into electronics, books, and other higher-margin products, but these efforts only added complexity to operations that were already struggling with basic grocery fulfillment. The company negotiated emergency financing arrangements with existing investors and attempted to find strategic partners who could provide both capital and operational expertise. Discussions were held with traditional retailers like Kroger and Safeway about potential partnerships or acquisitions, but these talks never progressed beyond preliminary stages because WebVan's financial position was deteriorating too rapidly. The company also explored merging with competitors like homegrocer.com, which was facing similar financial pressures, but the combined entity would have had the same fundamental business model problems that were driving both companies toward bankruptcy. The final months of WebVan's existence were marked by increasingly desperate attempts to find solutions to problems that may have been unsolvable given the technology and consumer behavior of the era. The company's leadership team, which had been replaced multiple times as investors lost confidence, tried everything from dynamic pricing algorithms to partnerships with existing grocery stores. They experimented with different delivery models, including allowing customers to pick up orders at neighborhood depots, but none of these pivots gained meaningful traction. The fundamental issue was that WebVan had been built around assumptions about consumer demand, operational efficiency, and unit economics that proved incorrect in practice. The sophisticated automation systems never achieved the reliability and speed that the business model required. The customer base never materialized at the scale necessary for profitability. The delivery logistics proved far more complex and expensive than anticipated. Most critically, consumers in 1999 and 2000 were simply not ready to embrace online grocery shopping at the volumes necessary to support WebVan's massive infrastructure investments. WebVan officially shut down operations in July 2001, just 26 months after its public offering, having burned through approximately $1.2 billion in investor capital. The company's bankruptcy filing revealed the staggering scope of its financial losses, including $800 million spent on distribution centers and delivery infrastructure, $200 million on marketing and customer acquisition, and millions more on executive compensation and administrative costs. When WebVan's assets were liquidated, the sophisticated distribution centers that had cost $35 million each to build sold for less than $1 million, primarily for their real estate value. The custom delivery trucks, GPS systems, and robotic fulfillment equipment were sold for pennies on the dollar to industrial equipment dealers. More than 4,000 employees lost their jobs when WebVan closed, and investors who had poured money into the company during its IPO and subsequent financing rounds lost nearly everything. The collapse sent shockwaves through Silicon Valley and became a cautionary tale about the dangers of pursuing growth at any cost without sustainable unit economics. The story of WebVan's spectacular failure offers profound lessons about entrepreneurship, market timing, and the difference between visionary thinking and practical execution. Louis Borders was undoubtedly right about the long-term potential of grocery delivery, as evidenced by the success of companies like Instacart, Amazon Fresh, and numerous other services that have made online grocery shopping mainstream. However, WebVan was simply too early to market, attempting to build a business model that required widespread broadband internet adoption, sophisticated logistics technology, and consumer comfort with e-commerce that would not emerge for another decade. The company's mistake was assuming that massive upfront investments in infrastructure and rapid expansion would create sustainable competitive advantages, when in reality those investments became crushing fixed costs that made profitability impossible at realistic customer volumes. WebVan also underestimated the complexity of grocery logistics, from maintaining cold chain integrity for perishable products to managing the seasonal variations in demand that make capacity planning so difficult. Perhaps most importantly, the company failed to develop a viable path to profitability at modest scale before attempting nationwide expansion. Modern grocery delivery companies learned from WebVan's mistakes by starting with smaller geographic areas, partnering with existing stores rather than building new infrastructure, using independent contractors rather than employee drivers, and focusing relentlessly on unit economics before pursuing growth. WebVan's legacy lives on not just as a cautionary tale about .com excess, but as proof that being right about the future is worthless if you cannot survive long enough to see that future arrive.